Emma buys a rental apartment. Daniel invests the same money into index funds. Both believe they made the smarter move. One expects monthly rent checks. The other expects compound growth. But when you actually track their money for 20 years, something surprising happens. Because one of them underestimated the hours, and the other underestimated the power of compounding. To keep this fair, Emma and Daniel start in the exact same position. They both have $60,000 saved. They both earn $60,000 a year. They live in the same city, same age, same starting line. The only difference is what they do with their savings. Emma uses her $60,000 as a 20% down payment on a $300,000 duplex. She takes a 30-year mortgage at 6.8%. Her monthly mortgage payment is about $1,950. She rents the property for $2,400 per month. On paper, that's $450 in monthly profit. Emma feels like she just unlocked a cheat code. She owns property, she has tenants, and every month someone else is paying her mortgage. Daniel takes the same $60,000 and invests it into a total market index fund. No tenants, no mortgages, no leverage, just a simple strategy: buy the market and hold it. He also sets up automatic investments of $350 per month. After that, he mostly ignores it. His friends ask what he's investing in. He says index funds. The conversation ends quickly. For the first 3 years, Emma feels like she made the right choice. Every month, rent hits her bank account. She drives past her property and thinks, "That building is mine." Meanwhile, Daniel logs into his brokerage account occasionally. The numbers move up, then down, then sideways. Nothing exciting, no asset he can physically see. Just numbers on a screen. But feelings and financial math are rarely the same thing. By year 3, Emma has collected about $86,000 in rent. But the full picture is more complicated. Property taxes, $3,500 per year. Insurance, $1,800 per year. A plumbing repair, $1,200. A broken appliance replacement, $900. And 2 months where the unit sat empty between tenants. Once everything is counted, Emma's real profit is far smaller than the original spreadsheet suggested, and that's before counting her time. Late-night phone calls, weekend showings, and coordinating repairs. Daniel hasn't done much at all. His portfolio started with $60,000, with steady contributions and market returns averaging around 10%. It grows quietly. Year 3, around $85,000, no emergencies, no tenants, no repairs. Just compounding slowly doing its job. But Emma still has one big advantage: leverage. Her $60,000 didn't buy a $60,000 asset. It controlled a $300,000 property. If the property appreciates just 3 to 4% annually, the value climbs to about $340,000 after several years. Her equity grows faster than Daniel's investment early on, and that's the reason real estate often feels powerful. By year 7, Emma has dealt with a roof repair costing $7,000, rising insurance premiums, increasing property taxes, 3 different tenants. Her rental income has increased slightly, but so have her expenses. Her cash-on-cash return is now around 4 to 6% annually. Respectable, but not the effortless income people imagine. Daniel's portfolio has grown to roughly $160,000 to $180,000, not because of brilliant stock picking, because he kept investing and didn't interrupt compounding. At this stage, something important starts happening. The returns on his investments begin generating more money each year than his contributions. After a decade, Emma's property value has climbed to roughly $400,000. Her mortgage balance has dropped significantly. Her equity is around $200,000. Daniel's investment portfolio sits in a similar range, about $190,000 to $210,000, depending on market conditions. At this point, they're surprisingly close, but how they got there is very different. Emma used leverage and effort. Daniel used patience. After 20 years, the gap becomes clearer. Emma's property is worth roughly $550,000. Her mortgage is almost gone. Her equity is close to $500,000. Daniel's portfolio, with steady investing and 10% returns, lands somewhere around $500,000 to $600,000. Very similar wealth outcomes, but very different journeys. Emma managed a physical asset for 2 decades. Daniel mostly waited. The real debate was never real estate versus stocks. Both can work. The real question is, what kind of investor are you? Do you prefer leverage, control, and active management, or diversification, simplicity, and long-term compounding? Because over decades, wealth is built less by picking the perfect investment and more by sticking with the strategy you can maintain. And if you're wondering what happens when someone combines both strategies, investing in the market while owning property at the same time, that's when the math becomes really interesting. But that's a different story.